Listen closely, because what I'm about to reveal isn't some theory or speculation floating around social media. This is happening right now, in real time, and by the time the mainstream media catches on, it might already be too late to act. While most people were going about their regular lives last Thursday night, something unprecedented started unfolding in the global silver market. Physical silver began vanishing from Chinese vaults at a speed nobody has ever witnessed before. Not gradually, not slowly, it's disappearing. And once you understand the real reason behind this, your entire perspective on wealth protection will change forever. Before we dive deeper into this crisis, I need you to do something critical right now. Hit that subscribe button and turn on those notifications. I'm serious. This channel, The Final Wealth Warning, exists precisely for moments like this one. What's unfolding right now could reshape the entire financial landscape in the coming weeks. And subscribing today could mean the difference between being prepared and being caught completely off guard. Don't wait until everyone else figures this out. Act now while you still have time. So here's exactly how this crisis began to surface. Late Thursday night, images started circulating inside exclusive metals trading communities. These weren't news articles or official announcements. These were raw documents, actual withdrawal receipts from multiple Chinese vaults across different cities. The pattern was identical everywhere. Physical silver marked as delivered and immediately removed. Within hours, more confirmations kept flooding in from various sources. By the time trading desks in New York opened Friday morning, the situation had already escalated dramatically. Shanghai markets were pricing physical silver near $82 per ounce, while New York paper futures remained stuck below $80. That price gap isn't just some minor discrepancy or trading opportunity. That's a massive crack forming in the foundation. That's the sound of a paper-based system losing its grip on a physical commodity. This isn't retail investors jumping on some trending opportunity. This isn't speculation driven by hype. This is the world's largest industrial economy making calculated strategic moves to secure real metal before the rest of the world wakes up to what is actually happening. China isn't gambling here. China is executing a plan. Now, let me take you back 6 months, because understanding how we got here is crucial. Half a year ago, the silver market looked completely normal. Prices hovered around $50. Shanghai and New York moved in sync like they always had for decades. The system functioned smoothly because China played a critical role as the global balancing mechanism. Raw silver from mining operations in Mexico, Peru, and other producing regions would flow into Chinese refineries, get processed into finished bars, then move to vaults in London and New York. Western inventories stayed healthy. Prices remained coordinated. Everyone assumed this arrangement was permanent and stable. They were wrong. Something fundamental shifted around early autumn. Chinese manufacturers started changing their buying patterns dramatically. We're not talking about investors or speculators here. We're talking about actual factories, solar panel manufacturers, electronics producers. Companies that normally placed monthly orders suddenly started securing 3 months of supply at once. Inventory that typically sat in storage was being pulled and used immediately. Market analysts brushed this off as seasonal fluctuations. They completely missed what was really happening. By October, inventory levels on Chinese exchanges weren't just declining. They were plummeting at an alarming rate. Then came the announcement that changed everything. Beijing revealed new export restrictions on silver. Starting January 1st, any silver exports would require direct government approval. Only massive state-connected producers would qualify for permits. Smaller independent refiners got shut out completely. Foreign trading companies got shut out completely. The message couldn't have been clearer. China was building walls around its silver supply. Here's why this matters more than most people can comprehend right now. China doesn't just mine silver. China controls the refining process. Between 60 and 70% of all global silver refining capacity exists in China. That means silver extracted from mines in the Americas often cannot become usable metal without passing through Chinese facilities first. Western nations outsourced this critical infrastructure decades ago to cut costs. Now the consequences of that decision are becoming painfully obvious. And here's the thing about silver that makes this situation so critical. Silver isn't optional in modern manufacturing. You cannot build solar panels without it. You cannot manufacture advanced electronics without it. You cannot produce electric vehicles or modern power infrastructure without it. If you don't have access to silver, production lines stop. Period. There's no substitute. There's no workaround. So when China signaled it was keeping silver within its borders, procurement managers at corporations worldwide did the math instantly. Buy whatever you can right now at whatever price, or risk shutting down your factories later when there's nothing left to buy. That's the exact moment when Asian silver prices didn't just increase. They exploded upward, and they haven't come back down since. Under normal market conditions, when silver trades higher in Shanghai than New York, traders would simply buy in New York, ship it east, and profit from closing that gap. That arbitrage mechanism is completely broken right now. You cannot ship metal that isn't available to ship. Arbitrage only functions when physical supply actually exists. Right now, it doesn't exist in the quantities needed. Now, let's examine what's happening on the New York side. The COMEX officially reports hundreds of millions of ounces sitting in their inventories. On paper, that sounds reassuring. But here's what those numbers don't tell you. Nearly all of that silver is classified as eligible, which means it's not actually for sale. It belongs to other parties. The metal that actually matters, the registered silver that can be delivered against futures contracts, has collapsed by over 70% in recent years. And just in the past few weeks, most of what remained has already been claimed by buyers demanding physical delivery. When futures traders demand physical delivery of their contracts, the system is supposed to honor that request. That's the entire foundation of legitimate price discovery. But when too many participants demand actual metal at the same time, the truth gets exposed. There isn't enough physical silver to back up all those paper promises. Meanwhile, Shanghai's inventory numbers are lower on paper, but they represent real metal. 1 bar equals 1 actual bar. No accounting tricks, no leverage, no multiple claims on the same ounce. And every single ounce that enters those vaults gets immediately absorbed by industrial users who need it for production. That's precisely why Shanghai prices reflect actual reality, while New York prices reflect promises that may not be kept. We've witnessed silver price spikes before in history. In 1980 and 2011, each time paper market leverage drove those moves higher and then exchange rule changes crushed them back down. This time is fundamentally different. This time, the demand driving prices isn't speculative money chasing profits. It's industrial necessity. You can crush a speculator by raising margin requirements or changing trading rules. You cannot crush a factory that needs silver to keep operating. This creates what market analysts call an inelastic bid, and it's one of the most powerful forces in any commodity market. When silver prices dip, buyers don't back away and wait for lower prices. They accelerate their purchases. Corporations don't care whether silver costs $80, $90, or $100 per ounce. If they don't secure that silver, their entire production stops. Paying a few extra dollars per ounce means nothing compared to the cost of shutting down entire supply chains. That's why every single price dip gets bought immediately. That's why price floors keep rising higher. And that's why the paper market is trapped in an impossible position. Suppress prices artificially, and you lose all credibility when people can't actually buy at those prices. Let prices rise naturally, and you expose the shortage that's been building for years. Before we continue, I want to hear from you. Drop a comment right now telling me where you're watching from and whether you think the situation resolves quietly or explodes into a full crisis. I read every single comment, and this community's insights matter. Also, hit that like button and share this video with anyone who needs to understand what's really happening. Engagement helps this message reach more people before it's too late. And right now, that matters more than ever. As we move into the coming weeks and months, pay close attention to one critical indicator. If Asian markets continue pricing silver significantly above New York, the world will eventually stop caring what the paper price claims. Price discovery will shift to where metal actually changes hands between real buyers and sellers. This situation isn't just about one commodity market. This is about control, about energy independence, about manufacturing capacity, about which nations secure critical resources first and which nations get left scrambling. Silver sits at the absolute center of the modern economy. And here's the uncomfortable truth nobody wants to acknowledge. We are consuming more silver every single year than we are producing. The deficit has been running for 5 consecutive years now. So here's the question you need to ask yourself. Are you going to wait for mainstream headlines to tell you what's happening? Or are you going to read the actual data while it's still whispering instead of screaming? By the time television news covers this story, the opportunity to prepare will have already passed. Now, before you think this is just another commodity story that will fade away like others have, let me slow down and explain something crucial that most people completely miss. They assume markets move purely on emotion, fear, and greed, hype cycles. But the most powerful force driving any market isn't emotion, it's necessity. And silver has quietly crossed the line from being a nice thing to have, to being something modern civilization cannot function without. Think carefully about what happens next in this scenario. Solar panel production doesn't pause because silver becomes expensive. Electric vehicle factories don't shut down because one metal becomes inconvenient to source. Data centers don't delay expansion because commodity prices moved higher. These operations absorb the increased cost because they have no choice, they always have. And that means higher prices don't reduce demand like they would for optional goods. Higher prices confirm the demand and reveal how critical this metal has become. This is exactly why what we're witnessing right now poses such a danger to the paper trading system. Futures markets were originally built on a fundamental assumption. Most participants would never actually demand physical delivery. contracts would get rolled forward. Cash settlements would be accepted instead of metal. That core assumption is breaking down, slowly at first, then suddenly all at once. Every single ounce that gets pulled from a vault tightens the pressure. Every premium paid in Asian markets exposes the gap between paper and reality, and every day of delay in acknowledging this situation makes the eventual price adjustment more violent when it finally comes. Now ask yourself these questions. If silver were truly abundant and plentiful, why would any government restrict exports? If inventories were actually healthy, why would refiners hoard available supply? If prices were fair and accurate, why would physical buyers completely ignore paper market quotes and willingly pay significantly more just to secure metal today instead of tomorrow? Markets don't behave this way when supply is plentiful. They behave exactly like this when something essential is running out. And here's the aspect almost nobody discusses publicly. Once silver gets used in industrial applications, most of it disappears from the available supply forever. It's not like gold that gets recycled and stored in vaults. Silver gets dispersed into tiny circuits, solar panels, electronics, and infrastructure in quantities far too small to economically recover. Every single year, more silver leaves the recoverable supply permanently. That's not someone's opinion. That's basic physics and economics. Now combine that permanent loss with 5 consecutive years of global supply deficits. Combine it with declining ore grades at existing mines. Combine it with rising energy costs for extraction and refining. Combine it with geopolitical fragmentation, where nations no longer trust open international markets. The result isn't temporary volatility. The result is fundamental repricing of the entire market. This is why central planners are getting nervous behind closed doors. This is why exchanges remain conspicuously silent. This is why financial media moves slowly to cover what's actually unfolding. Because once the general public understands that an artificial price suppression cannot magically create physical metal, confidence in the system shifts. And confidence, once lost in a market, never returns quietly or easily. Let me be absolutely clear about something important. This isn't about getting rich quick. This isn't about catching some trading opportunity. This is about recognizing when a system built entirely on leverage and paper promises collides head-on with a physical resource governed by geology and physics. Paper systems work perfectly fine until suddenly they don't. And when they finally fail, they fail fast. If you're still watching at this point in the video, you already understand more than 90% of market participants out there. And that tells me you're not here for noise and entertainment. You're here for real clarity and actionable information. And if you haven't subscribed yet, do it right now, not later, not after the headlines break. This channel exists specifically to warn people before events become obvious to everyone. Once the crowd agrees on something, the opportunity has already passed. What happens next won't be announced in advance with some official press conference. There won't be a statement telling you the paper market has failed. You'll know it's happening because premiums will explode overnight. Physical deliveries will face unexplained delays, and prices will gap dramatically when markets reopen after weekends. History doesn't repeat itself perfectly, but it always rhymes with previous patterns. And right now, silver is rhyming with historical moments that completely reshaped financial systems. Stay grounded in facts. Stay rational despite the noise. Don't let short-term volatility shake your conviction when you understand the fundamentals. And remember this above everything else. Real physical assets don't need belief or faith. They only need genuine scarcity. This is the final wealth warning. And what we're witnessing right now is only the beginning of something much larger. Stay informed, stay prepared, and I'll see you in the next one.